Paul Overy, welcome to the podcast.
Thank you, Gavin.
Paul, thank you so much. First of all, I got to admit, we're on YouTube here today, recording all of this, and we're here in the Ask About Wealth podcast studio. So thank you, first of all, for the invitation to come and talk to you on yours. And now we are switching sides and I'm going to interview you. And I think what I like to do, if you know from my own content that goes out there, there's a lot of people that are listening in that they're interested in Ireland and the economy and property prices and housing and all this kind of stuff. You are in a slightly different side of the market insofar as you're in the financial space. Tell us a little bit about what you do, and then we'll get into how you started doing it.
Sure. Well, I mean, as you say, I now am full-time in Ask About Wealth. It's only about a year and a bit old. And we kind of started it, myself and my partners. My partners are two much younger gentlemen than me and who are the tech heads, as I said to you before we started shooting.
The tech bros.
Yeah, the tech bros. I typically turn up and do the yacky stuff and they do everything else. So, but we basically tried to take advantage of a new medium. And that is the whole area of social media, and as you say, YouTube and other channels. We did a survey just before we started Ask About Wealth, where we talked to a number of, I suppose, what could be called millennials, and the high-income millennials, because Ask About Wealth is aimed at high-income earners. And we spoke to them and we asked them a bunch of questions. And the one question, every one of them answered the same way. The only question, indeed, they answered the same way was, do you use a financial advisor? And the answer was a universal no. And we asked them why, and they talked about, DIY apps and the ability to do it themselves. And they talked about trust issues with the whole financial advisory world. And the second one resonated with me because I've been kind of banging that drum for some time. But I was then able to tell them a number of things that they didn't know. And, and they saw, as I was able to give them information, rather than an industry that's predominantly focused on giving you product, giving them information, they could see the value in the information rather than the product, I mean, there are, I think somewhere around, there's 2,500 financial advisors, in inverted commas, in the country who hold the QFA, professional qualification. So there's at least 2,500 people out there who can flog you product. But there's very few people giving information. And what Ask About Wealth is giving information that wouldn't otherwise be available.
It's a good way to start. A little bit like myself, we give out plenty of information around the property industry and housing and all that kind of stuff. It's obviously a very different world than you and I grew up in. And tell us, getting into the financial industry to begin with, leaving college, so to speak, what was your path that brought you into it?
I said it to my son recently. I'm not sure anybody grows up saying, I want to be a financial advisor.
No.
They want to be a fireman or a footballer or a doctor or whatever it might be. And certainly I wasn't growing up saying I want to be a financial advisor. In fact, I actually ended up in the financial advice business almost by accident. Because when I left college, I was thinking at the time, and it was the early 80s we're talking about, so I'm showing my age here, Gavin, but I was trying to see, well, what's the next big thing? Where is the world going? And of course, in the 80s, the answer was a resounding computers, and programming. So having done economics and social science when I was in college, I was then saying, well, I'll try and get a trainee programmer's job. And the closest I came to a trainee programmer's job was with the New Ireland Assurance Company. And I got down to the last two, and then I was disappointed. The HR guy rang me and said, the fellow who was working for New Ireland got the job. So I said to him, well, is there any old job you'd give me in there? So I'll be the fellow working for New Ireland when the next one comes up. And the rest is history. I ended up becoming a maturities claims clerk in the New Ireland Assurance Company. And 40 years later, I'm still in the same business, although not with the same company.
And not reaching customers in the same way.
Absolutely not. Yeah. Reaching customers in a way that was unimagined.
Well, on the topic of customers and stuff, it's you and I know each other from our mutual previous lives, and I think I was saying to you that I can more or less date the time that we met down to the birth of my daughter, who's just turned 20. So we've known each other 20 years. But I haven't seen you probably in, I'd say, 15 years or something like that. So it's great to get together. Like, we were talking about 2008, and obviously 2008's it's a big rift in many people's lives. It tore a lot of lives apart. Tell us what 2008 was like for you and your experience.
The start of 2008 was excellent because at that time, Gavin, I'd established a business called Financial Engineering Network with a number of business partners. And towards the end of 2007, start of 2008, we were in negotiations to sell that business to a much larger financial institution that shall remain nameless. And we'd come to heads of agreement. And I had published my first couple of books by that time. Both had been on Irish bestsellers, which was great. I had an opportunity to publish internationally. But that needed a bit of time. So as this deal was being done, the broad agreement was that I would get cash for my shares and the other partners would get equity in an equity swap. And so the heads of agreement had been signed, and I decided, well, that's done. I'll walk away now. And because, as I said, I was getting equity anyway. I wasn't part of the onward sale. So a bit like the story you told me about ink drying, the ink hadn't dried or hadn't actually been placed on the contract. But as I said, heads of agreement. So I walked away on the assumption that I'd have a relatively large 7-figure sum in my bank account not too shortly after that. And that was in January 2008. And we all know what happened in April 2008. We had the major crash. The company that was buying my company, its share price fell by 50 or 60% in a day, which wrecked the equity deal with my business partners, which meant the whole deal fell apart. And instead of walking away with the 7-figure sums, I eventually walked away with very small 6-figure sum. And was really back to the start again. And, so I don't have the property nightmare story to tell maybe around that time, but just as affected. And what I had assumed was a job done, if you like, became a job that had to be done all over again.
Yeah, very much. I say a lot of people can relate to that. And I know because I get quite a lot of messages from people whenever we talk. And I mean, it's funny. I talk about 2008 because it's a defining moment in many of our lives. But the reality is it's 16, 17 years ago at this stage. So I think many people are like, really? You're still talking about 2008? I mean, it kind of maybe shows
we're still talking about the Titanic too.
Yeah, that's true. That's true.
And major disasters tend to stick in our minds, don't they?
One of the reasons that I thought it would be very interesting to have you here is some of my own clients, when I told them that I was meeting you, they were all like, oh, ask him about this, ask him about that. And many of them are following your content as it is. And so when it comes to giving out the advice that you give out, I mean, rather than going into anything specific, what's your general... I mean, the point that you were making earlier about the fact that you're not flogging a product. There's a lot of things that people just don't know that they don't know. And that's part of the problem.
Yeah. Well, I think one of the ways of describing, I said it, I think, in the first couple of pages of the original book I wrote. What's lacking in people is financial intelligence. And I don't mean financial cleverness. Intelligence as it's used in Central Intelligence Agency, which is in information.
Yeah.
I had a client of mine years ago who was a prostodontist. And a prostodontist, I believe, is the highest form of dentistry qualification you can have. And he said to me the day we met, he said, Paul, I had 22 years of formal education. I didn't have 1 hour to teach me about money.
Yeah, so true.
Which is an amazing fact, isn't it? When you think that despite the fact that we had a finance minister back in the day who didn't have a bank account, according to him, I'm not sure I believe that. Yeah. But, you know, we're all our formal education is about readying us for a world of finance. And whether morally that should or shouldn't be, somebody else can have that debate. The fact is, it is. You know, you get walked into, you know, you get your first, as I did, I got my first job at the age of 14 as a lounge boy in the Sands Hotel in Portmarnock. And I get walked into the AIB in Santry by my mum because this is where she banks. Yes. And I still have that bank account today, you know. Everything is about preparing us for a world of financial matters. Decisions. And yet we're given no information, no knowledge about it. And indeed, you know, you talk about when we first met, and that was shortly after a kind of eureka moment, because when we did first meet, I was kind of 20 years or thereabouts in the financial business. And I'm a bit of a slow learner maybe, because it suddenly dawned on me that I didn't seem to be any richer. My clients didn't seem to be any richer, which begged the question, who was getting richer? And the answer I came up with was the institutions I was working for. You have this financial world where people paid to make their shareholders money tell you they're paid to make you money. Now, that doesn't compute with me. You know, you can't serve two masters.
Yeah.
I mean, and by the way, I have no problem with people's motivation being profit. My own motivation often is profit, but it's being it's being open about that. It's being honest about that. You know, I was talking to a consult the other day, and I said we don't give out to a Volkswagen garage for not selling us a BMW.
Yeah,
because well, if you want to sell the BMW, stop being here. Go to the BMW garage. You know. So, but that's the reason we're able to make those decisions is it's very clear branding, isn't it? We know it's a Volkswagen garage because the big VW is over the door and the business card has VW. In my business, you're handed business cards with independent financial advisor on it. And yet this person is paid to sell you a prepackaged product. A product, by the way, which enshrines the profit of the institution that's manufactured it. Which already enshrines the profit of the fellow who's paid to sell you it, which means that from your and my end user profit, our profit isn't necessarily no better than third place. So at that eureka moment, slow learner as I was, I thought we have to find a way of providing financial data and information to people profitably, of course, because profit keeps the lights on, but in a way that it gets rid of that bias.
So you're just getting good advice without any kind of angle or
without any axe to grind, as it were. You know, I was talking to somebody on a consult the other day, and we were talking about retirement funds and how beneficial they can be. And I said to them, the way I'm talking, you'd think I was selling you this, but I'm not. I'm just telling you the benefits of that type of vehicle in your circumstance. What you do with that information, as I would have said to this chap on the consult, is up to you. You know, whether you take my advice or not, financially, I don't care.
Yeah, yeah.
And that there's where the lack of bias comes in, and I think that's resonating. Certainly, as you know, we do hourly consults where people book them 1-to-1. We do them over the interweb, and if I asked everybody, which I generally do, what has drawn you to this, and what is drawing people is impartiality.
Yeah,
is the fact that you're not selling them a product.
Yeah. It's a good point, all right, because I think a lot of people go out there and they're just not aware. Like when you speak to, for example, you go and speak to somebody that is selling a house, they're employed by the developer, we'll say, and the developer is paying them to go and sell that house. And so you're not going to get the information that says that, oh, by the way, there's a bit of an issue with, there's a river over there and it's a little bit close, and whatever it might be, you're not going to get the kind of the truth about it. And
or the whole truth.
Maybe. Yeah, you'll get sort of
you'll
most
get
of
some
it.
truths.
Yeah, but you won't get the negatives and stuff. Tell me this, Paul, in terms of the kind of advice that you get a lot of consult calls and stuff. How many people are buyers of property that are looking for advice or anything of that nature?
Well, I mean, first of all, the average client I'm talking to on consults is in their mid-40s. And as you know, most people in their mid-40s will have had some dalliance with property, be that their home or other things. I think, I look on property as, one of the, certainly one of the major asset classes that can help generate wealth. Some asset classes, government bonds, for example, or cash, they're not really about generating wealth. They're about keeping what you've got.
Yes.
But, the two predominant asset classes that can produce wealth are property and stocks. And I would say, my counsel is that both are long-term investments. I don't talk to people who are getting rich quick. I don't have a crystal ball of what the future will do. If I had one, I wouldn't be sat here talking to you, or because things would be very different if I could predict the future. But what I can do is learn from the past. What I can do is look at long-term yields and returns.
And trajectory.
And recognise that, and again, just to quote from something I said to somebody on a consult the other day, if the future of the financial world isn't akin to the past, then we have to envisage the end of capitalism. We have to envisage a fundamental change in the way the Western world works. Now, with President Trump in the White House, maybe that's possible.
Feudalism.
Yeah, maybe it is. But, I even with that, I can't see that happening. So, the past, history in terms of financial world tends to repeat itself, as you know, in the property business, as I know in the in the stock and shares business. And as long as you have time, and as long as you don't get called out, and that's, I think, if you look back into the property crash in 2008 to 2011, the people who were hurt worst by that were the people who couldn't sustain the property.
Yeah.
If they'd been able to survive that, they would have thrived on the other side. But the people who didn't get that opportunity were the ones who were called out, who had over-leveraged.
And that's usually because of short-term. The short-term, flip, or, I'm buying at this price. It doesn't make sense from a rental point of view, but who cares, because next year I'll sell it for more than I paid for it. And that was the way people were buying at the time. It's changed. I'm curious your view on the current housing market. What do you think about prices?
Well, I mean, I will not pretend to have anything like the knowledge you have on this subject, Gavin, but again, from history, there are two predominant influences that I can see on house prices. One is the supply and demand. I mean, that's economics 101, isn't it? Yeah. I lecture in a private business college, and I often would hold up to the kids a piece of coal and a diamond. I say, these are both made of exactly the same thing. And one is so common, we buy bags and bags of it, we set fire to it to keep us warm. Yeah. And one is so rare that we polish it and cut it and we give it to our loved ones, and they wear it proudly, and it becomes an heirloom. So, but they're exactly the same thing in terms of the molecular, but one is rare and one is common. And the more rare things are, the more valuable they tend to be. So, in terms of the housing crisis, if you like, until supply equals demand, it's going to continue. Save for the other influence, which again, in my experience, is interest rates. You know, I mean, affordability. So at 4% variable rate, you know, X number of people can afford to borrow to buy house A. At 5%, X minus certain number can afford. At X 6%,
it gets lesser and lesser.
Yeah, so you get a lesser. So the two major influences: supply versus demand, and the cost of debt. And, you know, if the cost of debt is rising, you've got, you know, a slight downturn. I don't think, by the way, a short, you know, relatively modest debt cost increase would do anything to the current Irish market, because the supply and demand thing hasn't been fixed.
Well, it's down to the necessity. Like, if it's not like, you know, you used the example of stocks and shares and things like that. The slight difference, I guess, is that you don't need a stock and a share, whereas you do need a roof over your head. And most people would be looking at property and saying, I can rent or I can buy. And if I buy, maybe I'm actually going to end up owning the property, but also the financing cost is probably less than what I'm paying to rent the place.
Yes.
And so it does make economic sense.
It does. And I mean, and that's often what I say, let arithmetic be your guide. You know, arithmetic doesn't lie. You know, I've got a 9-year-old daughter who knows 4 and 4 is 8. You know, so, and we all have had a basic understanding of arithmetic from the age of reason, perhaps from the age of 7. So let arithmetic be your guide. Run your numbers. You know, that's all. And as you know, you and I talked about earlier, before we started recording this, not only you run your numbers based on current circumstances, but consider a change in circumstances. Run your numbers if interest rates are 1% higher, 1% lower, 2% higher, 2% lower. And look to see, if you're investing in property, look to see that you could ride out any problem.
Storm.
Because, you know, I again, going back to the kids in the college, I said to them recently, I've said, you know, I've lived through 6 major recessions in my life so far. And I was telling them, and if you're lucky enough to live as long as me, you'll live through 6 major recessions in your life. Because the system at work is a boom and bust system.
Yeah. Based on greed and all of the ego and the emotions that I mentioned when we were speaking earlier is exactly what's driving all of that.
Absolutely.
And if you look at the collapse of the banks in 2008, it was because of the bonuses and the fact that these guys, it didn't actually matter the risks that they were taking, because the reward was the immediate profits that were being generated.
And longer term, a lack of responsibility when the you-know-what actually hit the fan. You know, how many bankers ended up, I mean, if you and I ran our businesses the way the banks ran their businesses up to that point in time, or for a while up to that point in time, we'd be in prison, Gavin. For fraud. You know?
Yeah, there's a lot to be said for it, and a lot of people feel that way about you know, who is one of the big issues that I see actually is that the developers and investors in property, they often are seen as contributing to the downfall of the Irish economy. And I mean, there's a certain element of truth in that, but it was triggered by Lehman Brothers and the collapse of, you know, subprime in America and all that. It obviously came to Ireland, and then everyone was buying like crazy, and you had the Maple 12 or whatever, or the Maple 10.
Yeah.
And those guys that had billions borrowed from Anglo-Irish Bank and stuff like that. But the hang up of that is still today, there's a kind of a perception that the property investors, the landlords, they're all greedy, and they're basically, I get this stuff on my social media all the time. They're parasites, because you're taking a property that could be owned by a family or something. But the reality is not everybody is looking to buy, and there's people out there looking to rent. And if you are a landlord, you provide that service.
And as you well know, Gavin, to whether they're looking to buy or not, qualifying to buy,
is the other thing.
You know, there's a whole bunch of people who would like to buy, but who don't qualify.
Yeah.
For the, you know,
and they won't for some time. Yeah.
No, or may never.
Yeah,
qualify.
Exactly. Yeah.
You know, so it's not about want. I mean, you know, we live in. I said it to you in our, you know, when we were talking earlier, that I used to say about property, for 800 years we weren't allowed to own anything. And then suddenly we want to own everything.
Yeah.
And there might be, in the Irish psyche in that sense, there might be a bit of sense. I say it slightly tongue-in-cheek, but there may be some truth in that.
Well, there is. If you look at, it's hard to compare markets, but if you look at, say, for example, Berlin or something like that, the huge swathes of that population living there would never, ever own a place.
I believe more than 70% of the French population live and die in rented property.
Yeah.
So it isn't the universal, now, it has to be said, I suppose, they have better tenancy agreements, they have long-term leases. So, here typically residential leases are a year long, aren't they? Where, you can get... I was talking to somebody, a Portuguese lady on a consult the other day, and I didn't realise this, but in Portugal, for example, and here's maybe a good idea for our legislators to think of, if you give a 10-year lease to your tenant on a residential property in Portugal, you pay half the income tax you would pay on a 1-year lease. So they're actually incentivising the long-term lease. And, isn't that the complaint? If I can live and die in my property, whether I own it or not may be irrelevant.
Yes, that's true. Actually, that brings me to the recent news that we heard coming out of the government was that they're thinking of getting rid of rent pressure zones. And they're also thinking about bringing the tax incentives back for landlords and property owners and stuff like that. You would have remembered Section 23 and all that kind of stuff.
Indeed, yeah.
What is your view on the kind of tax breaks that they could introduce?
Well, the first thing I would say, and I've done a video of this a long time ago, and I talked about my dad buying his first house in Limerick in 1962 for 800 quid. And the point I made in that video was that when my dad bought that property, on a mortgage, of course, because he was earning 44 quid a week or whatever he was earning at the time, the capital was tax deductible and the interest was tax deductible. So forgetting about inflation, if we just compare, today the capital is not tax deductible.
Yeah, it's only interest.
And so, some of the interest in many cases is tax deductible.
And it's only deductible if you're registered with the RTB.
Yeah. So you've got this situation that, forgetting about the property or inflation in general, homes are much more expensive to buy today than they were in 1962.
Yeah.
Because of the tax breaks.
Yeah.
So if we want to solve the home crisis, then bringing tax breaks back for the buyer could be a route to doing that, or could certainly help. The problem I saw, you mentioned Section 23, and I remember it was the late 90s maybe, I remember my brother-in-law buying a 3-bedroomed detached home in County Clare. On a height overlooking the sea. Beautiful place. Paying, if my memory serves, 33,000. Was that pounds before that?
Punts.
Yeah, I think punts then. Whereas a 2-bedroomed terraced house in the town, Section 23, with a view of another 2-bedroom terrace house back and front, was something like 85 grand. The problem with tax breaks on property has been that all it has done is bolster the profits of the fellow who's building it.
Yeah,
all it did was put up the price. So if they bring in tax breaks, they have to simultaneously bring in some sort of way of limiting that. Because tax relief goes up by 5 grand. What happens? Every property in the country goes up by 5 grand.
And you can see it in the first-time buyers thing.
You can.
The market is now shifted.
So it has to be some way of giving. I talk about pension funds, and the beauty of a pension fund buying a property, or indeed any other asset, but we're talking about property, is that the pension fund brings the tax break to the property. It doesn't buy the property with the tax break attaching to it.
Yes, yeah.
Which means that the price of the tax break isn't reflected in the price of the property. Whereas if you allow the property to have the tax break, then the buyer is buying the tax break as well as and has been asked to pay a premium.
Gotcha.
So the best way to buy, now you can't live in a property you buy in your pension fund, unfortunately, so it's not about buying homes. But purely from a tax perspective, the best way of buying investment property tax efficiently is to do it with a retirement fund.
Yeah, for sure.
Because your retirement fund, if you have 100 grand in your retirement fund, it only costs you 60 grand to put it in.
Well, let's get into some of that, Paul, because I do know that a lot of my own clients, and I'm sure some of the listeners that are here, they will either be business owners or they will be, we'll say, contractors, subcontractors, and they have a trading business that they pay 12.5% tax on. But if they decide to go and take some of that surplus cash and put it into a company that will buy a property, or if they buy the property directly in the company, suddenly there's all these additional taxes that they pay and the stuff. Tell us about the benefits of creating a pension.
Well, probably easiest to say, first of all, you're absolutely right. That, as I say about limited companies, or indeed holding companies that people talk about to buy property, they're really a tax deferral scheme. Not a tax avoidance scheme. It just kicks the can down the road. Because as you rightly say, first of all, the corporation tax on unearned income, on investment income, is 25%, not 12.5%. So there's the first mistake. People think, I'll buy it in my company and I'll only pay 12.5% tax. No, you won't. You'll pay 25% tax. And the second thing, of course, is the property's still in the company. So if you want the property out of the company either has to sell you the property or sell the property and give you. But in either way, the company pays capital gains tax.
And then you do.
And then if you sell it, you pay capital gains tax.
And then there's also the undistributed income tax.
And you've got the
well.
closed company rules and 20% surcharges, absolutely. But to answer your question directly, it's probably easier. Here are the tax benefits of a pension fund. Forgetting about what type of pension fund, and I know I have quite strong views on different types. But if we set those views aside for a second and just focus on the tax break, what a company-sponsored pension scheme allows your company to do is, first of all, move money from its balance sheet to your balance sheet through the conduit of the pension fund and write that movement off against corporation tax. So if you're a trading company, 12.5%. So 12.5% of that money is paid by the state effectively. So that's the first benefit. The second benefit is it's moved from the company balance sheet to your balance sheet, and you've paid no tax on it because contributions are tax exempt. Within limits, yes, but they're fairly generous limits. The third benefit is you're de-risking your company because now that money sits off balance sheet and therefore is protected from the creditors of the company. It doesn't belong to the company anymore, it belongs to you. So you've got tax relief to the company, corporation tax relief. You've got tax-free ownership to the beneficiary, the named beneficiary, the company owner. You've got de-risking of the commercial activity of that company because the balance sheet is now lower in value. And when you invest money inside that bucket, if you call it a bucket, it pays no income tax on the income it generates and it pays no capital gains tax on the gains it makes. So if you compare 10 grand into your pocket versus 10 grand into your company pension, 10 grand into your pocket is 5 grand after tax.
Yeah.
You invest that 5 grand, you make 5% a year, you get to keep 2.5% a year. 10 grand into your pension fund is 10 grand. You invest it, you get 5% a year, you get to keep 5% a year. So as I often say to people, if I, and this is when I used to sell pensions. You think I sell them now, but I don't. But when I used to, I'd say to people, if I did in the Middle Ages what I do now, I would have been burnt at the stake as a witch. Because if you go back to that example I've given you, this is the same money, leaving the same company, invested in the same product, delivering the same return. And you simply double your wealth by using the retirement fund. Now, there is a price to pay, Gavin, for that use, And that is, you can't dip your hand in that cookie jar for a while. Generally speaking, 50 is the youngest age, 70 is the oldest age. You can get it extended to 75 if you wish. But so you can't go down the shops and spend it on a Mars bar.
Which is probably a good thing.
Well,
because
forced savings.
Discipline.
Yeah. But that's the only disadvantage. Now, other disadvantages can be the type of product and the charges on it and all that sort of stuff. But if we're just talking about the pure tax benefits, they are the tax benefits of a retirement plan. You can double the amount of money you get to keep, and you can double the amount of money you get in the returns. Who could argue with that?
And telling me this now, one of the questions that came up for me was, let's say the person followed this advice and was active in putting money into their pension and buying a couple of properties, and the properties have gone up in value. And let's just say you're in this fortunate position that you've turned 65 and you have 2 million sitting in property wealth sitting in your company. What happens if you decided, I want to now?
Well, I'll answer that in a second, but just when I get asked that question regularly, and just to remind you that 2 million would be 1 million if you did it any other way.
Yes, yes.
So that's the first thing to say. We have a problem here, but we have a problem with 2 million instead of 1 million.
Yes.
Because the 1 million or the 2 million, now that you're going to spend some money, is going to attract tax. So we're 100% ahead in that simple example. But the answer directly to your question is that, if you have to, we'll take the 2 million because that's the figure you said. You can take 25% out as a lump sum.
Tax-free?
No, you pay tax. First 200 grand is tax-free. The next 300 grand is at 20%. But 25% of 2 million is $500,000. Tax at 20% on 300 grand is 60 grand. So you walk away with 440 grand of the 500 grand. That's a tax rate effective of 12.5%. So that's pretty good. Any income you generate from the remaining 1.5 million in our example is taxable in the normal fashion, but you have the normal tax credits against it. So you have your earned income credits or tax credits. You've got all of that sort of thing. So it is taxable down the line. And I suppose the final thing to say in that regard is that they're Irish rules. Who's to say you will be in Ireland when you dip your hand in that cookie jar?
Exactly, yeah.
And as a European Union citizen, for example, you could be anywhere in the European Union. And to give you a simple example, there are 2 jurisdictions I know of in the European Union today that will offer a 7% a year income tax rate on foreign pension income for a decade. So now, I'm not saying
does
you
Spain
should.
happen to be one of them?
No, it does not. No, Spain isn't one of them. But the point being, I suppose, and I say this to everybody, the secret to tax minimisation, Gavin, is to look forward and say what's likely to happen and what can I change today that will de-tax those events. So if you're 55 looking forward to 60 and you're going, oh God, I'm going to pay 48%, 40% tax, 8% USC. Actually, you'll still pay PRSI at 60, but we'll leave that aside. You at that stage might say, well, now's the time for me to be planning not to be resident in good old Ireland when I stick my hand in that cookie jar. And I mean, there's lots of famous examples of people. And, we're not talking about breaking the law here, Gavin. We're talking about understanding the law.
Exactly.
And using it to your and your family's best possible advantage. But to go straight back to your question, you have the 2 million, you have $500,000 out with 60 grand in tax, and the rest is taxable in the normal fashion. But bear in mind, it would have been only 1 million if you'd done it any other way.
But just on the specifics of, say, there's 1.5 left, is that still in a pension?
Yeah.
Or so?
Yeah, well, it doesn't have to be. You could take it all out and pay tax on it if you wanted to. But generally speaking, the proper advice would be, now draw your income. And by the way, once you do dip your hand in that cookie jar, under, again, Irish rules, the Irish revenue will force you into taking income.
Right.
So it's not as if you can park that 1.5 million in your example. Although that being said, you can move the pension fund. Instead of moving yourself, you can move the pension fund to a different EU jurisdiction.
Interesting, yeah.
Where the EU, their rules apply, not the Irish rules. And that can be actually avoided. So there's a business in Dublin, for example, that has a sister business in Malta. And the vast majority of what it does now is do exactly that.
Interesting.
It moves Irish retirement funds
to
Malta. And in doing so, the Maltese rules apply, not the Irish rules. And in Malta, you can have 30% as a lump sum, not the 25%. And you're not compelled immediately to take income, having taken the lump sum. So I suppose the message is there's always a way to skin the cat, as long as you know which cat needs to be skinned, and when it needs to be skinned.
And tell me this, another question that would pop into the mind of somebody who has a pot there like that. What if they were to pass on?
Pop their clogs.
Pop their clogs. What happens to your pension?
Well, often the answer to that question is a bit complex because it depends on what type of pension it is. But broadly speaking, for the most common of the pensions that's used today, it just passes in your estate. So there's no tax benefit to the estate and the beneficiaries. If there's 1.5 million left when you're finished with it, whether that was 1.5 million in your pension fund or 1.5 million in cash or 1.5 million in property, the tax will be broadly the same. But it doesn't die with you, I suppose. And where I think people get confused because there's this thing called an annuity.
Yeah, that's the thing that I think people don't like.
That's a different thing altogether, where you swap your capital for a guaranteed return.
For as long as you
live. And which will be fine if you live to 106, but maybe not so good value if you live to 64.
Exactly. So the next year you're gone.
I would typically counsel people, certainly with the type of money in pension funds that you're using as an example, that they steer clear of annuity for not only the inheritance reason, but frankly, you can probably create better income yourself without having to give away your capital.
Paul, tell us some of the questions that you get from clients that have property that, maybe some structures or some ideas that just people are not aware of.
Well, I think the biggest question I get around property is how do I give it to the next generation without them paying a whole bunch of tax on it? And that seems to be, as I say, the most popular question I get. And I won't go into huge detail here, but it's a bit like what I said about the pension funds. Planning can sort out a lot of these problems, but planning by its nature has to be in advance. One of the things that I have said recently on one of our own videos is, in Ireland, we're brilliant at talking about death after it's happened. Yes. We'll celebrate it and we'll have the wake and we'll have the month's wine and we'll drink whiskey and we'll sing songs and we'll tell funny stories about the deceased. We're brilliant at that. What we're not so bloody good at is talking about it before it happens. We've got an older generation who perhaps are at times, dare I say it, embarrassed by wealth and don't want to show it too much. And a younger generation who don't want to raise it because doesn't that mean I want dad dead? But it doesn't. If you can talk intergenerational about property, and I was saying to you earlier, there was a survey done recently which said Irish household wealth passed 1.2 trillion euro, and over 800 billion of that is property. The vast, that's 68%, I think I did the number. The vast majority of household wealth in Ireland is property. And that's going to, if that amount of money, the other part of that survey said there's just short of 300 billion in retired households. Okay, interesting. And that's going to transfer to the next generation over the next 20 years. That's a 95 billion grab. Yeah. In tax, in inheritance tax.
That's what I was going to ask you about, because I think we're calling it the silver tsunami.
Yeah.
And it's because of all the baby boomers that are now reaching 70, 80, 90 years of age over the next decade or so. That 300 billion is going to transfer.
It's going to transfer. And as I said, roughly 100 billion, 33% of it
will be tax.
Wow. So grasping that nettle now, understanding that there are things to be done, understanding that if your son raises it with you, it doesn't mean he's wishing you dead. Understanding that if you raise it with them, it isn't you predicting your death. I mean, there was another statistic we had recently. Only 27% of Irish adults have a will. 27%.
That's crazy.
It's madness. And I put that down to, we think if we go and make a will tomorrow, we'll die the next day. I mean, ludicrous. First of all, I don't think we have that influence over the universe, to be honest. But it is superstitious, as you say. So people are dying without a will at all. People are dying and assets are being delivered to, 3 or 4 different beneficiaries, making them all business partners. Saying to a fellow the other day at a very sizable house, I said, well, what happens if one wants to buy, one wants to sell, one wants to keep it and live in it, one wants to rent it out? There was 3 kids. I said, what happens is rouse.
Yeah, exactly.
If he had envisaged that in the beginning, he could have done something. But there are always, nearly always, I suppose, opportunities to plan your way out of the major tax liabilities on property, especially in the transfer from one generation to the next. But you have to grasp that nettle. You have to talk to somebody who know what the hell they're talking about. And you have to be prepared to be open and honest. I saw Warren Buffett, who I'm sure you know of.
Of course,
one of the richest men in the world, one of the most successful stock market investors, certainly the world has ever seen. And he said recently that he rewrites his will every 2 years, and when he does, he sits his family down and he shows it to them.
Yeah, no surprises.
No surprises. So that there isn't this argument, well, what Dad really wanted was, what Mum really wanted was. No, there can't be that argument. I bloody told you what I want.
Yes, yeah.
Here's my will. And he said that gives an opportunity to explain why he's done it, to explain any benefits there are to the way he's divided assets, and then to allow them the opportunity to ask questions. And maybe even, because in Buffett's case, his kids are all 60 years of age, maybe even give some ideas of themselves. Yes, yeah. Or, as you say, well, Dad, don't give that to me, give it to my kid. So the biggest, very, very long-winded answer to your question, but the biggest question I get asked about property is how do I manage its transfer from one generation to the next? And the answer is you do it in advance. And the longer you do it in advance, the more tax benefits you'll incur.
Paul, I think I was watching the time. Tell us, how can people find you?
Well, they can find us on various Instagram. We're on TikTok. We're on LinkedIn. On other channel, YouTube. That's all at Ask About Wealth. We have a new website just launched recently, www.askaboutwealth.ie. Go on there. You have access to all the various content. You have access to, we've just launched a new masterclass, which is a kind of learn at your own pace type stuff. You can book a consult. Everything we offer is available, www.askaboutwealth.ie.
Well, my final question, Paul, I wanted to get that out first so that people don't stop the podcast in the middle. I always ask my guests this question, and it's now, knowing what you know now at the age that you are, what advice would you give to the 20-year-old Paul that was starting out in his career?
Don't leave financial engineering till the ink is dried on the contract. Don't assume that a heads of agreement will turn into an agreement, I think would be the biggest one. And beyond that, I lost my brother when he was 42. He died of a brain tumour. And David, my brother, was in the same business as me. And I remember thinking, because I was older then, so I think I was 44 when he died. And I remember thinking afterwards that David and I had the same kind of career. We were doing 15, 16 hours a day. And we were going home to our respective missuses and children and promising, well, look, it'll be all grand. You know, in 15 or 20 years' time, we'll be so well made that, you know, all of this will be. And of course, tomorrow isn't promised. And I think that's, you know, my father's father had a saying, live every day like it's your last, because one day you'll be right. And so I don't contribute to this, you know, live in hair, shirt and ashes until you can live like a king. I think you have to enjoy life. And, you know, the final thing is nobody lies on their deathbed wishing they'd worked more, wishing they'd accumulated more wealth. We lie on our deathbed wishing we'd spent time with our dad or our mum or our children, kids, or our wife, or a significant other. So that's the advice I would give him. He wouldn't listen to me, though. You know, that's the problem, because what is that youth is wasted on the young, you know, and in the sense that, you know, you think you know everything. And as you know too, Gavin, there are some lessons you can't teach somebody.
They have to,
you know, as a parent, I've had to learn to let them make mistakes, because that's the only way they learn.
Well, on that, I thank you very much, Paul, and wish you the best with everything.
Thank you very much.
All right, guys, I hope you found today's conversation with Paul Overy as interesting and as insightful as I did, and I hope you took lots of notes. Again, a very quick reminder that the Accelerator next cohort is kicking off in a couple of weeks' time. It's going to start with an in-person event in Dublin, guest speaker, lunch with myself and the other members and all that. If you are looking to scale a portfolio, or if you have an existing portfolio that you want to add to and you want to raise money around and things like that, nothing's going to accelerate your progress like the Accelerator. So I hope to see you there, and I'll catch you in the next one.